Yes, students, now we will see the trade credit and its policies related to trade credit. As we have discussed in the previous discussion about trade credit, what is the trade credit, how the trade credit difference we find out. The credit we allow to the customers is accounts receivable. The credit we get from our suppliers is the accounts payable. The difference between the accounts receivable and accounts payable is the amount of firm's capital consumed as a result of the credit transaction. The credit that a firm extends to its customer is kind of money tied up. So every time it has to be very careful while doing this. Now, how it happens, let us see an example. Trade credit example 210 net 30. Here is the example is 210 net 30. What does it mean? It means the customer will get a 2% discount if he pays within 10 days. Customer gets 2% discount if he pays within 10 days period. If he does not pay in 10 days, then he has to pay back the money within 30 days. So 30 days is the maximum period he has to settle the bill. But if he pays within 10 days, he will get a 2% discount. This is known as 210 net 30. If we see the timeline, if the purchase bill is for $100, if the customer made the purchase today, he has to settle the bill within 30 days. 30 days is the total settlement days. But within 30 days, if he decides to pay any day within 10 days, he will get $2 discount. That means he will pay only $98. If he fails to pay within 10 days, he has to pay the money $100 any time from 11th day onward up to 30 days. This is the way we read 210 net 30. 110 net 40 means 10 days, the total credit period is 40 days, but from any time within 10 days if paid, 1% discount. If failed to pay within 10 days, he has to pay on from 11th day onward any time, and the maximum is 40 days. So 210 net 30, 110 net 40, depending on your credit transaction, your offer from your suppliers, the agreement can be decided whether it is 210, 310, 110, 115, 120, 117. How many days, how much discount will be decided by the supplier. Now we calculate the effective annual rate. Effective annual rate, always 1 plus the annual percentage rate to the power n minus 1. Your firm purchases goods from its suppliers. This is example 19.3. Your firm purchases goods from its suppliers on terms of 115 net 40. 115 net 40. In the previous question it was 210 net 30. Here it is 115 net 40. That means to get 1% discount, you must have to pay within 15 days. So who is ready to pay within this date, he will for sure make the payment on the 15th day only, because he will not pay before 15th day. Why? He will use the money. On the 15th day he will pay, get 1% discount. If he doesn't pay within 15 days, then from 16th day onward, anytime up to 40 days, the same 100 will be paid, no discount. Therefore, if you are failing on 15th day, you will not pay any other day. You will pay on the 40th day, so that you can use the maximum, your cash. So, every time it is known that the maximum discount period is being used. If not used, the last day of the payment cycle is being used. Let us see how. Using the $100 purchase, an example of 115 net 40 means 1% discount if you pay within 15 days, or you have to pay within 40 days. So to get 1% discount, you will pay on the 15th day. or else you will pay on the 40th day, so that you will use maximum you maximize your cash use. So difference is 25 days. You need to compute the interest rate over 25 days and compute the EAR associated with the 25 days interest rate. Go to your Excel spreadsheet, please. I have uploaded the spreadsheet in your spreadsheet folder. Open the spreadsheet, please. This can be easily done in the spreadsheet. Let us do it. I'm just opening the spreadsheet. You also open the spreadsheet, please. Go to the example 19.3 and 3a. All these things are calculated here. The first is 115 net 40. The question says 115 net 40. 115 net 40. So what does it mean? Discount is 1%. Discount is 1%. So discount period is how many days? 15 days. If you are not paying on the 15th day, you have to pay on the 40th day with no discount. So discount is 1% for how many days? Total payment to be done, the last day of payment is 40 days. The discount period is 15 days. Therefore, the number of days credit period is equal to 25 days. 40 minus 15 is equal to 25 days is your credit period. Now 1% discount, say for example your bill is $100. Number of days in a year is 365 days. So discount is equal to 1% on 100 is equal to $1. So net amount to be paid after discount is $99. Interest rate is equal to $1 divided by $99, 1.0101%. All clear? Simply, that's why I said come to the spreadsheet, and we will do it a much easier way. So 1% is the discount on 100 is equal to $1. So net amount to be paid within the discount period is equal to 100 minus 1, $99. So the interest rate is equal to, APR is equal to 1 divided by 99, 1.0101. Number of days credit period allowed is 25 days. So this 1% is for, means 99 on $99, $1 is the benefit for a period of 25 days. Therefore, number of credit periods in a year of 365 days is equal to 365 days divided by 25 days, 14.6. Effective annual rate is equal to 1 plus APR to the power number of credit periods 14.6 minus 1, 15.80%. Now the next question, for example, the next question told as homework for you, but because I have done the spreadsheet modeling we have done, now only extracting the data, all the kind of answers, whatever the credit term, you can get the answer within no seconds. The next question is, your corporation with vitamin soda purchases goods from a supplier on the condition of 210 net 40. Go to the spreadsheet please, 210 net 40. That means what? Discount period 2%, period discount rate is 2%. For getting this discount, maximum 10 days. The amount to be paid maximum 40 days. The bill is $100. Number of days is 365. So discount paid, if you are paying within the discount period of 10 days, then you are getting $2 discount. Then how much you are paying within 10 days? $98. What is the interest rate? 2 divided by 98 is equal to 2.0408. How many days credit period allowed? 30 days credit period. How it is calculated? 40 days total, 10 day discount. So 40 minus 10 is equal to 30. How many number of credit periods in a year? 365 divided by 30 is equal to 12.1667. Right? Now effective annual rate is equal to 1 plus percentage rate 2.0408 to the power 12.1667 minus 1. Okay, so this is the way we calculate the credit term is being estimated whether you will use the discount or not. Say for example, in the previous case what happened, your effective annual rate comes 15.8%. So why this 15.8% for what? You are not paying on the 10th day, you are not paying on the 10th day, 15th day, 115 net 40. You are not paying on the 15th day, not getting the discount. Because you are not getting the discount, your cost of capital is 15.8%. Instead, what you can do, you can go to a bank, talk to a bank, you can get the money at a lower rate of return and use this credit period 115 net 40. You pay the money on the 15th day, get 1% discount, that will be equal to you earned 15.8%. You can give maybe for example 5.8% rate you can give to the bank, still you save 10%. So you have to be very careful before foregoing the cash discount. Cash discount is very, very costlier, so you should not forego the cash discount. You should approach a bank and get the cheaper cost of capital and make use of the discount. Take the advantage of the discount. Same here, you see, for the vitamin soda company, the cost of cash discount is 27.86. It should not forego. It should approach a bank and it should make use of this cash discount. And for example, if bank will demand 7.86, it will pay 7.86 to the bank, get 27.86 from the cash discount, still it saved 20%. So always try to calculate your cost effective annual rate of your cash discount and decide whether to use it or not. Benefits of trade credit is it is simple, convenient to use, and has lower transaction costs than alternative sources of funding. You know, your supplier is allowing you this credit, so it is very simple, not much complicated, flexible source of funds. Why? Because you're just getting from your supplier and it can be used whenever it is needed. If you don't need, you can pay the money within the credit period. For example, 115 net 40, so you can pay within 15 days. When required, you can use it. So it is very flexible. It is sometimes the only source of funding available to a farm. So your supplier is selling you on credit, so it is very easily available. Farms offer trade credit because this is when a company getting that trade credit. Company, you also have to give trade credit to your customer. Why? Because providing financing at below market rates is an indirect way of lowering the price for only certain customers. You have this credit terms different for different customer. For one customer, it may be 110 net 30. To another customer, it can be 210 net 30. Another customer, it may be 310 net 30. So, a three customer, three different discount rates are availed. So, depending on the loyalty of the customer, you can change the credit discount rate. Supplier may have an ongoing business relationship with its customer, so it have more information about the credit quality of the customer than any other kind of lender. So supplier knows the customer, so no problem. So the customer who can pay in time, the supplier can allow credit, no problem. He will pay the money. If the buyer defaults, the supplier may able to seize the inventory. That is another point. If you have allowed credit and your customer is not paying, you can seize the raw materials or the inventory. So by giving this credit, you are raising float. What kind of floats are there? Float means difference. collection float. This is divided into mail float, processing float, availability float. So collection float means the time takes from the time you sell the product and you collect the money, the difference between the days. For example, you are selling today, you are collecting after 15 days. It's collection float. And this collection float is divided into mail float, processing float, availability float. Means the customer has dispatched the check, but the check is in the mail. It will take 2 days to come to your place. That is called mail float, those 2 days. Once the check comes on the third day, it takes another 2 days to get processing in your accounting books. That is called processing float. 2 plus 2, 4 days. Once you processed, you send the check to the bank. Bank will take another 2 days to make you available the funds. Availability float. So total it took 6 days from the day customer paid the money and you used the money. This is called collection float. Disbursement float. Same happens for you also. Today you send the check to your supplier. It is there in the mail. Then the supplier cannot use the money. Then supplier will process in his books. He cannot use the money. Then he will put in his bank account. It will take 2 days to get clearing. So same like collection float, disbursement float also. The day you pay the check, same day it cannot be taken by the supplier. It will take some time. To make this fast, the new check clearing system has been introduced in US called Check Clearing for the 21st Century Act. You know, today this all these things might be a joke for you. Today you might not believe all these things. Why? Because of the 21st Century Check Clearing Act. Globally, it is in the global banking Basel norm. It is being incorporated. Now it takes very limited time to clear the check, isn't it? Today morning you have given for clearing. Maybe afternoon the money will be cleared. No mail float, no processing float, no availability float. So nowadays this became little faster because of the Check 21 or 21st Century Check Clearing Act. So this is the way customer mails the check. So it is in the mailing process, mail float. Farm gets the check, it makes entry in the books, processing float. Farm deposits the check in the bank, bank will make the processing, that is called availability float. Then funds credited to the account. Now we will see the receivables management. Just let me stop the recording here.